So we're going to go through and spend some time on the vocabulary that has evolved to describe the various components of the profile graph. And it's important to know what these terms are, what they mean, and most importantly, their implication. I want you guys to think, always think, and understand what you're doing. If I say, or Troy says, guys, the euro has a selling tail up here, well, what does that mean to you? I mean, that should, you should be able to write 2 paragraphs about the implications of that, but it has to come to you automatically. It has to be automatic. If this is a selling tail, then, if then, what's the implication? What do I do? Why? Etc. Don't just know a rote definition of a selling tail. It's it's a description of an auction process. Okay, each letter is a TPO. We've talked about that. Now, the rotation of price up and down is part of this price discovery process. It's the normal, natural state of the market to be rotational. Most activity in the market, most price movement is random. Most price movement is random. Remember earlier I said most of what you should be doing most of the time is nothing? That's because you want to avoid this randomness. That's what we have to avoid. You're constantly trying to avoid the noise, randomness, noise. So a rotation is just referring to the back and forth typical movement of the market. When we say, when you hear Troy talk about rotation in the room, this rotation or that rotation, we're talking about price rotating through a range. Now, some of this, these definitions, value area, initial balance period, these are legacy concepts from early market profile, and they were critically important and an integral part of reading the market profile when market profile actually through the mid-90s. And today, the 99% of the market profile educators and traders out there are still using initial balance period, value area high, value area low, and all this stuff. I don't even have these lines on my chart. I don't have the initial balance period on my chart. Now, there are benefits still in the stock market of being aware of what happens in that first hour of trading. I did a study years ago, and I used to update it. I haven't updated it in a long time. And this applied just to the stock indices in the day session. And it was pretty interesting study, and there was some useful tradable information in there. And I'm sure Troy shares this with you guys in the room. But 65% of the time, the high or the low of the day is made in the first hour of trading. Now, that's not as useful as it may sound at first glance, the first time you hear it, but it can be useful information. There are other things that you just don't do, especially in the stock indices. If the market has not broken out of the first hour of trading, and 3 or 4 ticks, 4 or 5 ticks, doesn't really matter, okay? I'm outside the range. But if you haven't had range extension outside the first hour, and it's the afternoon, you don't want to be fading the edges of the extremes because of the probability is dramatically increased that market's going to extend, and you don't want to get run over. So there are little things like that we still use. But in general, the initial balance period is sort of a moot concept, and it applies only to a small slice of one time frame that is just a piece of the bigger picture. So if I'm interested in trading in this particular day, I'm not so much interested necessarily in this initial balance period as I am what this market does, regardless of when it occurs, when it trades down into this area. This was a buying tail from the previous day. It was very strongly rejected. So I'm interested in this day, if price reaches this end of this level from the previous day, how it's going to react. When it reaches there is not all that important. Now, the other thing that I will say about the stock indices, and this applies to other markets, but in particular the stock indices, because the day session in stocks is still the overwhelming majority of the trading. At that point in time, if you get in a trade early in the day, for some reason, if you're selling against the Globex high or you're buying against the Globex low very early, hold that trade as long as you can, because what you may have done, what you have a legitimate, shot at having done, is you bought or sold the high or the low of the day. And if that's the case, then you can just sit there, and your expectation is for something, the minimum of whatever, roughly the average 10-day true range is at that point in time. And so that can help you. It's the little subtle things like that that can help you with your trade management. So, but it's part of this auction process. It gives you a reason and a rational, logical reason that has some basis in rigor to manage your trades, and when to trade, and where to trade, and how to manage a trade. If you get in a trade, if I get in a trade at around the opening, just before, just after, I'm looking to manage that trade differently than if I get in a trade at 3:30 in the afternoon. Any questions, let me know. Feel free to type them in. I'm trying to keep an eye out for your questions as we go along. Okay, the high volume node. The high volume node is a term that I coined 8 or 9 years ago. It was not used in market profile parlance. Now it has become. Now everybody uses it. Nobody knows where it came from. So I'm telling you, I coined this. I don't use the value area. I have found through experimentation that I'm better served, and it's more defined, and it gives better information to identify the high volume node. And I use a 25% setting. In other words, this is 25%, the smallest area, 25% of the trading in this range. And it's, I think you guys, if you go back and you look at the reports, if you go to the public blog and you look at the public blog, it's consistently uncanny how often the high volume node, which is a, much smaller area than the 70% area of a value area, how often the market reacts around that area as it does the extremes. In other words, you get it's an inflection point for trading. It can be, in this particular instance, you can see this, it was rejected, so it was acting as support. You had a buying tail here and a buying tail here right into this high volume node. In this particular, this is crude, actually. So here, here's a high into it. So the high volume node, really, I haven't done any sort of back testing or rigorous testing on it. This is sort of look and feel. But it is more defining, and I have found it to be extremely useful in what we're trying to do. Michael, you say HVN is what percentage of volume of days? 25%. That's you can set it. You can set these parameters in these software programs. I can set it to anything I want it to be in CQG, and I use 25%. Yeah, and it's 25% of whatever the profile unit is, Michael. These are individual day units, so that's what it is. If I were to combine these 1, 2, 3, 4 individual sessions, which actually this is all one auction, then it would represent 25% of the activity, the transactions in that range. Now the composite profile. The composite profile idea was first posited. Stoudemire actually talked about it. He talked about the larger degree auctions, but he never combined, I can't recall ever seeing a combined profile in any of Stoudemire's work. He did refer to it. He did refer to the larger auction and different days making up a bigger auction. But I'm pretty sure the first person that began using on a regular basis the composite profile, he calls it a meta profile, is Don Jones. And Don published his book, I don't know, 1994. Hold on, I've got it here. Let me take a look at it. 1993. Now, Don's book came out in 1993, and I'm telling you, it's revolutionary from a lot of different perspectives. And that's about the same time. Let's see, when did Mind Over Markets come out? Mind Over Markets came out in 1993 also. And Mind Over Markets is, well, is worthless compared to what Don Jones did. What Dalton did in his book was take Stottlemyre's concepts and basically rewrite them and add to them. And Don Jones has done it, basically took the profile concept and proved its validity from a gross perspective. He's a scientist. He tests things, and he was the first person that really realized that the ideas of Stottlemyre, as they were initially posited, did not do what they were purported to do. But he continued to dig in, and he found that by, the bigger auction gave the context, and that was valuable information. So Don Jones is the first person that really proved that you had to have the larger auction context through a composite of market activity to give a consistently valid reading on what the market was doing and to identify the areas from where you wanted to be trading. Christine, you say, what do the, you have a question about, let's see, I lost your question. What do the blue triangles, arrows, and the blue letters mean? Well, the blue letters, Christine, that's the point of control. Now, I'm going to get to that, okay? But the little arrows are where the market opens and closes in a given time frame. There's nothing special about the little triangles. You don't have to worry about that. But we'll get to the point of control thing here in a minute. This is what you're always trying to find. Now, this is corn, actually. Actually, this is corn over here. So what I've done, I've taken this activity, and when I see a market that has these non-directional high volume nodes. In other words, you've got this one's up, this one's up, this one's down, this one's down, this one's up, this one's down. That's two-sided trading. That's all one auction. I'll combine that. And this is typically what you'll get. You'll get the relative unfair highs, the relative unfair lows, and you'll have an area of greatest value. And you will find consistently that this is a critical area for the immediate trend in the market up to that point in time. Now, you can't see this over here, and we may look at this later, but you had a wide range up day. This was the proverbial step one. You had a step two, and now you're rotating around in a range. Price is accepting this area, and it's trying to migrate higher, etc. But it's holding this area. This is the critical level at this point in time in this market. Now, if we were to take these three individual days, combine them into one auction, then the market, I don't know where it closed, I guess it closed right here, would be between an important downside level and an important upside level, as defined by the high volume node. So we talked about the profile graph being a noise filter last week. That's what it is. It's a noise filter that helps you see what's going on in the bigger time frame auction. Okay, Christine, point of control. These little blue lines, you see I have highlighted them here. Here's the red line. That's your point of control. Now, this is another legacy concept of early market profile. And it was the attempt to determine who was doing what. The buyers were said to be in control if the trading was above the point of control, the sellers if it was below. And there was all sorts of stuff going on about, if you had, if you developed a point of control and there was a higher TPO count above it, it meant the price was likely to migrate lower. None of that proved to have any validity to it. I'm not even going to get into it. Another point about the point of control is the point of control in a developing auction is a moving target. The point of control in the market after 2 hours of trading in a given session is going to be different than the point of, or probably going to be different when that particular session is complete. So the point of control is a moving target, and it's not much use, especially early in a session. Actually, I don't find it to be of any use at all. There is no single magic price. That's why I use this high volume node. Now, a high volume node is almost always, I can't think of an instance or a circumstance where you would have a quote-unquote point of control that is outside the high volume node. I guess it could happen, but it would be rare and just a real oddity. Michael, you say, so how do we use HVN for trading? Well, you're going to find out. Single prints. Okay, single prints are, and this is an artifact from early market profile trading, they're a sign of conviction. But the problem with single prints on a profile graph is that there's sort of a chronological coincidence that depends entirely upon when that market started to trend. Single prints denote conviction, but you don't see single prints unless it just happens to be set up chronologically so that they occur and then leave single prints. And this is a perfect example of a market condition that is better viewed on a bar chart. And it's an ideal example of why it's critical to understand how to recognize the auction market condition on bar charts, because a lot of times a profile chart will obfuscate or hide the market activity that's really critical information regarding that auction and what you need to be doing. This is the profile view of this. This is a much cleaner, clear picture of the auction process than this, and what to do about it and how to trade it. Now, I've told you guys, when I look at a bar chart, I'm reading it through the lens of an auction. This is conviction. Conviction, there's only one party that can create conviction, and that's big money. The market is so incredibly rotational now. You have all this high frequency stuff, and the high frequency stuff is non-directional churning, basically. And you have so many spreads. There's a lot of most pure volume is non-directional, whether it's high frequency volume or a part of another trade, some sort of arbitrage or spread, a spread, all sorts of spreads. It can be very simple spreads, or it can be very, very complex spreads, but most actual volume is not directional volume. That's why I think that you're much better off at times looking at a bar chart than looking at a profile chart. And a wide range bar is telling you there's conviction. There's no rotation in this 30-minute period. There's no rotation in this 30-minute period. So when this market trades down here, I can make an if-then assumption. All right, this market looks like it wants to go lower. There's a lot of conviction there. If that's the case, then we probably should not retrace very much into or very deeply into this structure. Well, the first thing that we did was begin to retrace deeply into this structure. So, there are times if I'm watching a market and I think this market, let's take a hypothetical, let's say this is a balance area. If I see this occurring, I'll just sell. I'll sell it and then sit back and see what transpires. Now, if I do that, if I'm selling this, where does my stop have to be? Well, my disaster stop has to be back above the bar of the conviction. And there are times where you or I get stopped out. I'll sell here and I'll turn around, and in 10 minutes I'm stopped out here. But I'm trading market condition. What I'm trading for, if I can get in this bar, is I'm looking for that initiative move. I don't mind, I'm not expecting this thing to trade all day like this when I see it. But what I'm hoping to catch is a move that begins with conviction, and then the sellers take control, the market begins to rotate, and the minor degree balance areas begin to form and begin making lower lows, and it develops lower during the day. Now that's trading market condition. That's not, and I'm going to show you some very specific, more well-defined setups than just clicking the mouse button and going long or short. I'll do that. Troy does that. Most people, after a while, after you develop a higher level of understanding and confidence with what's going on, you will do that too. But you don't have to. I mean, you can. I'm going to show at the end of this, of tonight, I'm going to show you one setup that if you didn't do anything but trade it, from now on, you'd be an all-star. Okay, so we're going to talk about conviction a little bit. Conviction is one-sided trading, and it's critical to catch conviction. You don't have to chase it. I will chase it on occasion. But ideally what you want to do is you want to be in the market before conviction really begins to manifest itself. And the only way you can get that trade is by understanding market condition. Because if you're sitting there and you're always reactive, then you'll find yourself late to the party and then getting stopped out because you're late. You know, you see this wide range bar, you weren't prepared for it, you weren't paying attention to what was developing in front of it. It occurs, you buy or sell, you get eager, and sometimes that works out, sometimes it doesn't. But we want to be trading as auction market traders. One way or the other, we want to find in our trade plans trades that put us in conviction. It's one-sided trading. Either the buyer or the seller is driving the market directionally with little normal rotation. And it's much, much easier to see on a bar chart. Visually, it manifests itself in wide-range bars. Wide-range 5-minute bars, wide-range 1-minute bars, 30-minute bars, 120-minute bars, etc. The other thing about market condition is that it gives you the scenario of what should not happen. If you have strong market condition, you're expecting certain things, certain market behavior that should occur if the direction of the market condition is going to continue. And it's very easy to identify because it's wide range. It's a wide range bar. It's a trend bar, and it's a much more complete concept than sitting around staring at a profile chart, waiting to see single prints occur. There's a lot of, single prints are conviction, but there's a lot of conviction that don't create single prints. Okay, this is a 30-minute chart of copper, and these are areas of conviction. You have these wide range bars. Now notice in some of these bars, all right, it's 30 minutes, there's overlap. That's okay. You're going to get varying degrees of rotation regardless of the time frame you're trading as part of the auction process. But if I see this market take off here, actually, if it retraces, then this gives me the opportunity to enter this if I've missed it in a defined manner. Because if this is conviction, if this is an initiative situation, conviction is initiative trade activity. You hear the terms initiative and responsive. Well, initiative trade activity is a trend. So if a market is trading initiatively, it should not retrace deeply or for long. So initiative and conviction are synonymous terms. Now, initiative behavior, conviction can occur within a two-sided trade. This is an example of conviction that sort of died up here in this area. But if you had seen this, you were aware this was going to be an area to keep an eye on anyway. But you never know when this is going to turn into this. That's why you want to try and identify market conditions when conviction is most likely to occur. Chris, you asked the question, so you fade. So you fade what? So you fade up here? I don't know if I would have faded this or not. If I were long, I would not have dumped my longs and gone short. If I'm long from down in here somewhere, I'm probably tightening my stop, but I'm not just rote going to fade this. What I want is this. So do you fade conviction? Are you being facetious? No, you don't fade conviction. That's one of the things you don't do, is fade conviction. Okay, the market forms some sort of balance down here, okay? This is a balance area. And then it starts to trade high. Whoops, that's not what I wanted. It starts to trade higher. And let's say this is a 30-minute time frame. It starts to trade higher. Now, do I want to sell this? No, you never want to do that. I say never. It's never a prudent thing to sell the top tick of a move or conviction. The overwhelming majority of time, you're going to have something like this occur and give you the opportunity that if you just, if you have to top tick, then you can put a stop here, you can sell here. But just to sell this, you will eventually run into one of those days where it just goes like this, and then it comes back just a little bit, and you add to your position, and then it goes like this, and it does this all day long. And all markets will do that on occasion. Most of the time, rotation bails traders out. But those traders have a death wish, and it will ultimately catch up with them. And the idea that the market always comes back because it's regressive, because it's going to retrace. You can fade these spikes and be right, 10 out of 11 days. But day number 11, you lose everything that you made for the quarter trying to fade a move that won't stop. And there's no rotation in it. This is something you really, as an auction market trader, you have no business doing. It is just selling the top tick of a move just because it moved, just because it looks extended relative to what happened for the previous 2 or 3 days. Look, up in here. So you begin some rotation here. If you sold this, I could understand it. Here's another spike up. You had some rotation occur. Here's another spike up. I had a lot of rotation occur. The overwhelming majority of the time, you're not missing anything by letting the market begin to show some sign of two-sidedness before you decide to be the genius that picks the top tick. All right, here's the 30-minute chart. And we spiked above this very important level. And when gold was spiking up here, it looked like, it was going to go to 1,700 and above. But it turned on a dime. Now let's go, this is a 30-minute chart. Let's see what a 5-minute chart looks like. Well, you spiked up here, and then you had some two-sided trades. So, Troy, this is probably what you're talking about in here, right? You had some two-sided trade. And we're going to talk about this in a minute. Not only did you have some two-sided trade that occurred, now this is a 5-minute chart, so this is probably 35 or 40 minutes. And if you sit there and don't try to be a hero, you have something that's objective, that has a higher probability of working than trying to pick the top tick in a spike in gold. Plus you have this selling tail, which we're going to talk about here in a minute. Okay, we're going to talk about buying tails and selling tails. Buying tails and selling. I'll tell you what. We've been going over an hour. I didn't realize that. Let's take 5 minutes, guys. Just 5 minutes, and we'll start again. Okay, buying tails and selling tails are a form of conviction. Buying tails or selling tails represent rejection. The market is rejecting higher highs or higher lows from those that preceded it. But now you have to be careful with buying tails and selling tails because they're sort of ubiquitous. They happen a lot. But if you're careful how you use them and how you trade them, they can be incredible entry signals and very, very well defined. And once again, this is where it's a huge advantage of learning to read a bar chart through the lens of these auction market concepts and trade that bar chart through the lens of auction market concepts.